the more a corporation has operating income, or EBIT, earnings before interest and taxes, of $750,000, the company's depreciation expense is $200,000. More is 100% equity financed, that means it has no debt, and it faces a 40% tax rate. Calculate the company's net income and what's its cash flow. All right, so let's take a look at that. Okay, so they tell us earnings before interest and taxes is $750,000. There's no interest expense because there's no debt. They're in a 40% tax rate situation. So if we take 40% of EBIT, we get $300,000. That leaves us net income of $450,000. They tell us that depreciation expense is $200,000. Now, depreciation expense is a bookkeeping entry, right? If you think about the accounting involved, if you remember your debits and credits or increases and decreases, when we record depreciation expense, we increase depreciation expense or debit it, and we increase accumulated depreciation by crediting it. Neither of those accounts are the cash account. So it represents a non-cash item. So we have to add that back, and we're able to calculate cash flow as $650,000. Okay, let's tackle this question next. Let's assume that instead the company had $5 million of assets and was 50% debt financed at an average cost of 11%. So how could we calculate net income and net cash flow in this situation? All right, so we start out with the same $750,000, but this time we have to take the $5 million times 50%, right? $5 million of assets, and half of that represents debt. If you remember the accounting equation, assets equals liabilities plus equity. So if it's financed at 50%, then half of that $5 million is financed with debt, times 11%. That gives us the interest expense. So now we have earnings before taxes, or EBIT. Take 40% of that, reduce it, you get net income of $285 and add back the depreciation. Okay, so we're able to calculate net income and net cash flow, assuming they were 50% financed with debt.